Good morning, everyone. Today is Wednesday, April 29th. My name is Matt Salm. I'm an investment analyst with the Milwaukee Company. And today I'm joined by Andy Wilms and Mike Wilms for our podcast, newly named the Market Commentators. Andy is the Milwaukee Company's president and CEO, and Mike, who is Andy's cousin, serves on our portfolio management and strategy teams. So, Andy and Mike, good morning.
Good morning, guys.
We'll start off with a quick market recap from Andy, since we're the market commentators after all.
Well, I always we'll take a quick look at what happened last week. It was the first down week in 3 weeks for Wall Street, with the Dow being down 1.9%. The S&P dropped over 1%. The Nasdaq held pretty firm. It was only down 0.2%. And so far this week, traders appear to be betting on the hopes of the economy will be reopening sooner rather than later. Monday, the Dow surged 350 points to close above 24,000. Tuesday, the Dow was flat. The S&P was down 0.5%, and Nasdaq fell by 1.5%. So far this morning, the market's up strongly. This is I'm talking Wednesday morning here, recording this a little bit before market open, but there's been positive news on the medication front, which is pushing COVID-19 medication front, which has been pushing markets higher pre-bell, and I know you'll be talking a little bit about that in a moment. So basically, in sum, following the sharp 34% drop since at the maximum back on March 23rd, the market's now rallied nearly 29% as of April 27th, but there's still a long way to go, right? We're still only about halfway recovered to the previous high on February 19th.
But a 29% rally is pretty big. Do you take that as a sign that the worst is behind us, or?
I don't think of that. I don't think of it that way. I mean, it's the shelter-in-place orders still remain, and you still have this social distancing guidelines. And while considerable progress does appear to have been made on the development of both a definitive treatment and a vaccine, there's still a lot of uncertainty surrounding both of those. But some good news this morning, again, we'll talk about. But we still have record high unemployment and ongoing business closures. So the possibility for a longer-term structural disruption cannot be ignored in my mind. It's still a distinct possibility.
Yeah, I tend to view things similarly as well. That it's the tail risk is still pretty wide. We can definitely face some structural issues. And on the COVID front, we passed a couple of not so great milestones in terms of cases recently, with global cases surpassing 3 million. And confirmed global cases surpassing 3 million, and confirmed cases in the U.S. recently passing 1 million. And deaths are obviously significantly lower than cases, which is good. But globally, we're still at over 200,000. And in the U.S., the latest numbers I've seen out of Johns Hopkins show we're at least 58,000 deaths attributed to COVID-19 in the U.S.
Matt, I saw this morning on that the number of people who died in the U.S. from the coronavirus now exceeds the number of people who died, soldiers that died in the Vietnam War.
Yeah, I saw that as well, and it's the mother of apples to oranges comparison. Yeah, still very, very sad indeed.
Shows the deep degree of the tragedy in our country, though, caused by this. I mean, and how long we felt the effects of the Vietnam War. We've felt that for decades. And potentially that could be the case here too.
Well, this is kind of nothing more than just a point of reference, and it's not minimizing what you guys are saying about the human toll of the COVID-19 virus, but one of the editorial pieces in the Wall Street Journal this morning talked about the 1957 flu epidemic and the 1968 epidemics. Now, if you think back, those points in time, the population was much, much smaller. But if you roll forward to the population size in the U.S. currently, The 57 flu epidemic claimed 230,000 lives, and the 1968 epidemic would have claimed 165,000 lives on a equivalent population basis.
Mm-hmm.
You know, we've been here before, and they estimate those two flu strains still exist. They're part of the flu vaccine that people receive, but there still are 650,000 deaths globally each year from those two flu strains.
Right, but we've had 2.8 million deaths globally from coronavirus so far, and we're far from
cases.
Global deaths over 200,000. I missed.
Right.
We have over 200,000 deaths globally, and we're far from.
It's not over.
Far from over. Yeah. So,
yeah.
Who knows where this is all going to shake out?
And yeah, far from over indeed. But as you talked about before, there is some promising developments coming out on the medical front. One thing that caught my eye was out of Oxford University, a study there being done on a vaccine that they had already started studying before the outbreak actually happened, related to other coronavirus or other coronaviruses. Right, and so they had already shown that it was at least safe for humans, and now they're at the more advanced stage of testing efficacy of treatment against this particular type of coronavirus. And I think they're rolling out a study with 6,000 people, hoping to complete it by the end of May, with potentially having first doses available, by September.
And that's a game changer if that in fact is true. And as we talked about a little bit before the program today, the fact is that it's very positive because it already has been used with humans, so we don't have to worry about the fact that it has to be proven to be safe for human consumption. And the chimpanzees that they're testing this on are the closest thing we have to humans. So the fact that it's been incredibly successful with them gives us cause for optimism that it might very well be effective in humans as well.
Yeah, and something we talked about before we started recording also is that at least Oxford doesn't have the same financial incentive to, exaggerate claims as could potentially exist elsewhere. Like, their reputation is the quality of their name, and they're not going to risk that. So if we're seeing good news out of an institution like that, there's a very high chance that it's legitimate. Yeah.
Right. Let's talk a little bit about the news about Denisphere this morning. Have you guys had a chance? I mean, it's just very breaking, so I don't know if you've had a chance to look into it, but apparently Gilead announced early this morning that its first trials of this new treatment, not vaccine, treatment, were quite positive. And, it was a preliminary study. It's not the definitive end all. We can't say we now have an effective treatment, but it does provide a solid basis for optimism that we should have a treatment for, we could very well have a treatment for coronavirus in the very near future. And if so, the flu will no longer be a death sentence for the vast majority of people who get it, which will be a game changer. I'm sure the very, very sick, they get the normal flu. It's very, problematic for them. If you have a lot of serious underlying conditions, this drug may not be as helpful as we would like. But for the rest of us, this could allow us, if we know we have an effective treatment, and if we do contract the disease, we're going to be able to get better. We have to, have this medication administered. That really makes it much more feasible to reopen the economy more quickly than
exactly. That would go a long way to alleviating consumer fears of participating as in their life as they had prior to the lockdowns.
Exactly. So people will be.
And I think that the key part about what I had read this morning about Gilead's success is that the trial review, the design of the trial had been reviewed by the FDA, and what they released this morning is that they met all of the trial's endpoints. So, I mean, it performed as expected, as they had designed the trial and submitted to the FDA for approval.
Yeah, I would say it's as hoped, not really as nobody knew what to expect, but I mean, as hoped. I mean, it was a positive result. Now there are issues with this medication, right? It has to be administered intravenously, which means you can't just take a pill. You're going to need some sort of medical involvement. Probably, I don't think it's going to require hospital stays or anything like that, like current treatments do. But it does require medical help. But by the same token, they found that the 5-day treatment was as effective as the 10-day treatment in this trial. Well, that's big, right? Because if you go
exactly
here and you're there half as long, or getting medical intervention for half as long, that's a big time positive, and it also so much smaller drain on the medical system. And the availability of the drug now doubles, right? Because you're using half as much to treat the patients who need it. So it's understandable why the markets have rallied on the news, it seems to me.
Yeah, I think those are all good points, especially about the doubling of the dosages if we have to cut treatment length in half. That's huge. And it's important not just in the immediate future, but if there's a second wave that does come around in the fall, as the CDC director has now warned about. I mean, lots of people have been speculating on this for a while, but the CDC director making a statement about the significant risk of a second wave coming around next winter, I think adds, again, a little bit more legitimacy to the claim. It's not just journalists speculating, right? So what do you guys make of that risk, or what are your...
I think it's a distinct possibility, because as I mean, that's what's kind of they've experienced to some degree in China, right, and in other parts of Southeast Asia. They're seeing some reoccurrence as restrictions are lifted. But by the same token, as our director of analytics, Jim Purcell, has done a lot of research into the amount of cases and whether the caseload has peaked or not. And his analytics suggest we are on the downturn of at least this first wave, right? And while we could see some reoccurrence, if that reoccurrence comes hand in hand with effective treatments, and that helps a great deal. And if you have a vaccine that people can take, then of course there won't be a second wave, right? So there's too much to really say one way or the other. If we didn't have treatment and we don't have a vaccine, then a second wave could be very, very dangerous. If we have those other two things, then the problems of a second wave are greatly mitigated, and we just don't know the answer to that yet. But I'm pretty optimistic. I'm not. I could say I feel the news today has been pretty positive.
Yeah. So I think some good stuff on the medical front. Should we transition a bit into more economics and policy? That
Sure.
works for you guys. There's a bit more certainty, at least in some of that discussion, as far as experiencing economic contraction right now. Mike, can you share a bit about the depth of that economic contraction and some of the details of it?
Well, the numbers just came out this morning on GDP for the first quarter, and expectations were a 4% contraction. It actually came in at a 4.8% contraction for the first quarter, and unfortunately, it's pretty easy to extrapolate out into the second quarter. If there's 26 million people that have now filed for unemployment, the second quarter is probably going to be considerably worse than the experience in the first quarter.
So we're officially in a recession now, right, Mike? I mean, that's confirmed now.
It would be, the definition is 2 back-to-back quarters of contraction, and it's pretty hard to see where we're not going to have a second quarter contraction as well.
Right.
So they can't actually call a recession yet, but it's coming.
Right.
So,
okay. Great.
Great. And today is the second day of the most recent Federal Reserve Board meeting. The expectations are for some clarifications on, first of all, what the Federal Reserve has done to this point, to support the economy as we go into a recessionary period. And then they're hoping for clarification on how long they're envisioning keeping rates at the current extraordinarily low 0 to 25 basis point level, and give the markets some kind of clarity how long the rate structure is going to resemble what we're experiencing today. So, which is extraordinary. The 10-year Treasury was yielding just less than 1% at 58 basis points.
Wow. And I think a lot of how long rates are going to stay at 0 depends on the shape of the recovery, right? And some of the commentary that's come out recently is not as much about V-shape or U-shape anymore, but maybe a recovery in phases. Is there anything along those lines that's caught your guys' eyes about maybe a first phase of the recovery and where supply bounces back, a second phase of the recovery where demand bounces back as consumer confidence soars?
Everybody is designing their reopening of their economy's plan. And I think the one of the key things for Governor Cuomo in New York is 14 days of declining hospitalizations. And then it's a matter of which part of the closed economy is eligible for starting to return to normal. And the interesting part is, as of yesterday, hospitalizations in New York had been down for 9 days in a row. So he's getting closer and closer to the potential for issuing a reopening of the economy in New York State, which obviously has been the hot spot for the virus here in the U.S. Each state has got a different program that they're considering. Georgia started to reopen their economy on Friday to a lot of political backlash, but they were talking about everything down to nail salons, restaurants, and there's obviously close human contact there. I mean, it's really kind of hard to generalize what the plans are for getting us back on track.
And I might just add, Matt, we got to focus on, we got to be more specific. Are we talking about the shape of the stock market's recovery or the shape of the economy's recovery, right? Because they aren't necessarily going to be the same. The stock market tends to be a leading indicator of
it's forward-looking.
Yeah, forward-looking. So, we've seen a V-shaped recovery in the stock market since March 23rd, right? I mean, it's as I mentioned earlier, it's gone up really quickly, really fast, much quicker than the economy hasn't shown any sign of improvement. But if the stock market can see looking forward, as Mike says, the potential for significant medical treatment, even though the economy might take a U-shaped recovery, the stock market could very well have a very sharp V-shaped recovery. We just don't know, and that's what a lot of investors are betting on at the moment. That they think a V-shaped recovery is in the cards for the market.
I apologize for spinning around here and showing you my back here, but I just checked. The market's up about 400 on the Dow right now.
Okay. Thank you.
Yeah. So in addition to stock markets having their own pattern of recovery, there's also a lot of interesting dynamics in the bond market. One of the things we had talked about a bit was muni bonds being potentially, attractive or risky right now. We tweeted about that a couple of days ago. If people follow us on Twitter, Mike, do you want to share a little bit more about what you see in the muni bond market right now?
Well, we had talked about this briefly before the start of the podcast, and going back to the 10-year Treasury yielding 58 basis points. A 10-year AAA municipal bond right now is quoted at 138 basis points. So that's more than twice the yield on a municipal versus a Treasury bond. Historically, the municipal yield will be something less than the yield on a Treasury with a comparable maturity. And the rhetoric is the states and local governments are going to struggle with declines in tax revenue due to the economy being closed. And that's a valid point, and their budgets will be under strain. But by the same token, they have taxing authority, and if we start to return to normal in a shorter period of time versus a long closure of the economy, I would say that the municipal bonds right now are a pretty good place to be from a risk profile and a historical after-tax yield compared to other fixed income alternatives.
And I agree with that. I would say I'm favor municipals right now over treasuries because of the things that Mike pointed out. And the government is taking historic measures in the corporate bond market, promising to buy corporate bonds, although I don't think they've actually entered the market yet. The mere assurance that they would do so if necessary has really supported the corporate bond market. And if they're prepared to do that for the corporate bond market, I think they would interject in the municipal bond market first. So I do understand the concerns about the municipalities' inability to service the debt that but I think the fact that the Fed has come out and said they're going to back them up mitigates some of that concern. So I think
and that's exactly right. Prior to the Federal Reserve indicating that they would buy not only secondary corporate bonds and corporate bonds into the less than investment grade credit rating categories, they had already indicated that they would step in and purchase municipal bonds.
I think the interesting thing is, will the Fed go too far and basically bail out the states? There's been a debate about that too, right? How much they should do, and a lot of things are getting thrown in under the wrapper of coronavirus, and you see certain states who had big time problems with their finances that way precede anything that anybody ever heard of coronavirus, looking to the Fed to say, listen, bail out our pension funds, bail out our, repay some of our debt, help us dig out of this hole that we are in. And that, in my mind, is a greater, risk in a sense, that you create this tendency or this where states are not held accountable for the decisions, the bad decisions they may have made in the past, so that their state spending, which wasn't supported by adequate revenue, or their poor decisions about how to invest pension funds or the amount of pensions they were going to pay, are basically they use this episode becomes the solution to those problems, which just leads to those problems repeating themselves, right? You got to learn from your mistakes, and
that's why you keep history.
Yeah, exactly. And if you don't have to pay a price for those mistakes, then you're bound to repeat them. Any parent knows that.
Well, and I think, just to clarify a little bit, I mean, the discussion about the potential for bailing out the upside down states, the New Jerseys, the Illinois, the Californias, and the majority of those problems are pension related. And it was granting unfunded exorbitant pension payments, not only pension, but healthcare benefits upon retirement. Those discussions are taking place in Washington, in Congress. So whether it's the Senate, whether it's the House of Representatives, and the goal for the Democrats at this point is to try and, as you had said, Andy, help with the finances in these states that are really challenged, using the coronavirus pandemic as an excuse to lever themselves into helping these states out. Ultimately, where we are right now, if there's any additional spending it will by and large end up on the Fed's balance sheet because there's just not going to be someone else to buy any additional treasuries that are sold to finance those kind of bailouts.
Well, and this is there's smart people on both sides of this debate, right? Some people would take the position that the states were due for a bailout for a long time, and this.
Well, they've been asking for a long time.
Well, I'm just saying, some people would argue that the bailout would have been a good idea a long time ago, and if this makes this more feasible now, then so be it. I don't know, Matt. How do you look at it? Have you given any thought to this issue? Do you have an opinion? I mean,
never let a good crisis go to waste.
Exactly.
Thank you.
And I think it's a
spoken
great
like
time.
a true politician.
But I think it's a great time to possibly extend federal money to states with strings attached so that they can make reforms that are very politically difficult possible. And then the state politicians can point at the feds and be like, oh, look, they made me do it. And the feds can point at the states, and everybody has somebody else to blame. But at the end of the day, we do things like reform, pension systems.
Yeah.
And so if we can get that done, that'd be good. Yeah.
I think you're right in the sense that if we can get some acknowledgement that mistakes were made and people accept that, and there have been lessons learned, and we will require, steps be taken to prevent those same mistakes from being repeated. That would make the bailout much more, feasible or responsible, I should say, in my mind. But the other side of the coin is we're already pumping such massive amounts into the economy, and the inflationary risks that come from pumping in all those dollars. Are we just adding to already a very dangerous situation by pumping even more money in by bailing out the states, increasing the deficit by even more? All we're really doing in that situation, of course, is shifting the deficit from the states to the Fed. Yeah. Now, so that if we say to the states, we'll give you the money, but you got to pay it back, and you have to raise taxes to show us and dedicate those new tax revenues to paying this debt back, then it makes more sense to me. If we say we're just going to give it to you, no strings attached, like some people have suggested, I think that creates a behavioral risk for encouraging future.
I think they call that moral hazard.
Moral hazard. There you go. That's exactly. I think that creates a moral hazard that we want that, as Mike indicated, could be much more costly than the not doing anything.
Yeah, and the devil's in the details with the specific design of the strings. Yep. So we'll see whatever happens there. But I
couldn't agree more. Yeah.
Going from the broad topics of macroeconomics and policy debates kind of back to the individual investor. Obviously, nothing that we talk about on this podcast is meant to be formal investment advice. But if you were hypothetically in the position to give advice to someone, I'm curious things that might be top of mind, especially given that the market has rebounded so strongly and that there's maybe elevated downside risk right now.
Yeah, that's a good point, and it really depends on the individual investor what they should be doing now. If they're all down in February and March, created a lot of anxiety for you, and it was really you were kicking yourself for being in the markets and really angered about the fact that you had such too large of an equity exposure. In other words, if you had overestimated your tolerance for risk going into this crisis, then I think you might want to look at this as an opportunity now to get your equity exposure more in line with your real true risk tolerance, which you've discovered. Has it been a costly thing? Most of the markets are still down, 15% or so. So moving from equities to less risky assets right now do come at a cost, but it's a lot less costly than it was back on March 23rd. So, I think now is a good time to reassess your risk tolerance. And if you're not as tolerant for risk as you one time thought, then perhaps changing your allocation from risk to risk-free assets or lower risk assets, it's an appropriate time to consider that.
That all makes sense. Another thing we've talked about a lot is diversification and the benefits of diversification for all sorts of investors. but that maybe hasn't been as helpful in this current crisis if things like small cap stocks have been hurt more than large cap stocks. So how do you think about that, and what is some advice you might give to someone thinking about lessening the amount of diversification in their portfolio?
Well, I'm still a big believer in the power of diversification as a way to reduce risk. It's oftentimes called the only free lunch in investing, and for good reason. Now, saying that, you certainly wouldn't come to that conclusion if you looked at what's happened the last 2 to 3 years, especially this year. But really, it's been a 2 to 3 year phenomenon. And on both the stock market and the bond market, diversification has been anti-productive. And in the stock market, the reason that's true is because so much of the gains have been concentrated in a very few number of names. You've seen the NASDAQ directly outperform, and the so-called FANG stocks, the 5 leading stocks of the NASDAQ, do even better. So there's been a lot of concentration in return. So those companies that have done well have pulled the whole index up. So large cap U.S. stock has dramatically outperformed the overall market. So if you have a diversified portfolio that includes mid cap and small cap and international stocks, your equity allocation is more than likely underperformed its benchmark. On the fixed income side, we've seen something similar, where long-term debt, 20-year, 30-year debt has greatly outperformed your short-term debt by more than you would normally expect, not because of the yields as much as because of the price appreciation. As interest rates have come down, the value, of course, of the long-term debt has gone up, right? That they have an inverse relationship. Interest rates to bond prices are inverse. And so up to this point, that has been, the place to be has been long-term. And if you've been in midterm or short-term or international debt, you've again probably greatly underperformed your benchmark. But I think there's good reason to believe that both of those conditions will reverse in the future.
Makes sense. Mike, you looked like you wanted to jump in at one point there.
Well, I mean, the thought would be where that outperformance has been is in the Treasury market. In here, as prices of Treasuries have gone up and the yields trended lower, spreads had widened on everything else. So if you had a corporate bond with the same maturity as a Treasury, the Treasury price might have gone up, but the corporate bond price would have went down. I'm sorry, I had somebody trying to come in my office. So
that's okay. That's okay.
It's fine.
I wasn't waving to my girlfriend, if that's.
What girlfriend? That's been a long time. But anyway, Matt, if I could just add a little something to what Mike was saying. Yeah. I would point out that there's good reasons to believe that diversification will again provide the benefits that historically has always provided. On the stock market side, we have, of course, the power of reversion to the mean, right? That time-tested principle that things that have tend to outperform recently tend to underperform in the future, and vice versa, because as something that's outperformed gets more expensive, right? And things that have underperformed are relatively less expensive, and investors love a bargain. So as these large US cap stocks become more and more expensive relative to mid cap, small cap, and internationals, you're going to see people get migrating into those cheaper sectors, and that should reverse, things should revert back to the mean where they are at the normal point of equilibrium. With regard to long-term treasuries, as low interest rates have been extremely positive for long-term treasuries, and the fact is that interest rates have been much, much lower for much, much longer than I ever thought I'd ever see in my life, first to admit it. All the things we've talked about in terms of the government bailing out the states, the government bailing out corporations, the government bailing out individuals, all of this new money, trillions of dollars being inserted into the economy, means there's more dollars chasing goods, the amount of goods and services the country produces. The GDP is going down, which means you have more money chasing less goods. And that by any definition, is a sure recipe for inflation, right? If you have more dollars chasing fewer goods, that is a recipe for inflation. So if inflation kicks back in, that's very detrimental to long-term bonds, right? Because their yields are so low and interest rates are going up. Generally speaking, I should back up and say, when you have inflation, it tends to lead to higher interest rates. Not always, but most of the times it leads to higher interest rates because the Fed raises rates to pull money back out of the economy because they know there's too much money in the economy causing inflation. So if we end up having inflation, and that drives higher rates, you'll see treasuries come down just as fast as they went up, making them be again, reverting back to the mean or lower. And lower, shorter term debt isn't as subject to that because it matures much quicker. So you'll get the cash in 2, 3, 4 years versus 30 years, which means you can reinvest the cash at higher rates when the bonds mature. So you'll be people who have been paying a price for being in short duration instruments, shorter term instruments for the last 2, 3 years could very, very well be rewarded for that in the years to come if we see a return to inflation and higher interest rates.
Well, and I think a really good summary of that would be, historically, the 10-year Treasury is supposed to represent a risk-free yield, which would be the sum of your expectation for GDP growth and inflation. And I think the break-even inflation number right now is someplace around 160 basis points. It's not a stretch for the 10-year Treasury to get back to something north of 3% if we return to a normal economy. And talking about 3% on the 10-year Treasury, if you go back to World War II, I mean, the average is something over 5%.
Right.
So,
if you get somewhere between 3 to 5%, the Treasury prices are going to, long-term Treasury prices are going to come down dramatically.
Which creates a whole nother set of issues with debt service, but that's for another conversation.
Yeah, I think.
Yeah. Of course, we're not saying any of this is going to happen, but the fact that all these risks are out there means that a well-diversified portfolio is more likely to weather the storm when any of these external shocks, could be a big factor.
And risk reduction comes at a cost, right? There's no doubt about it. There is a price to pay for protection. And so diversified portfolios have been paying that price for the last 2 or 3 years. My suspicion is that they'll be rewarded for that investment in the years to come.
That makes sense.
I agree.
Yeah. Well, thank you guys so much for joining me this morning for this discussion. If you enjoyed listening, please consider following us on Twitter @TheMilwaukeeCo. We discuss similar topics on Twitter and retweet pieces that we think are interesting. And we also have a newsletter that we release now every single week that comes out towards the end of the week. It's called Perspectives and Prospects. You'll occasionally see pieces by myself or by Andy in that, and other people at the Milwaukee Company are also authoring pieces for that newsletter. So if you want to get more perspectives besides just the three of us, the newsletter is a great place to go, and you can find that on our website.
Matt, can I mention one more thing? I want to encourage our audience to submit any questions that they would like us to discuss at our next week's podcast to our firm email address, which is firm@themilwaukeecompany.com. And if you submit questions for us, we'll be happy to consider them and talk about them for you.
Answer them as best we can.
Yeah. Which in your case is questionable. Just kidding.
I think that'd be a lot of fun.
Just kidding.
Cool. So yeah, thank you guys again for joining me. Thank you everybody for listening, and we'll talk to you again next week.
Bye now.
Bye-bye.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.